Hold versus sell. This is always a question the property developers face. So we're going to go through some pros and cons of these today and discuss what might be the right strategy for you. So first of all, there is no right or wrong. There's just pros and cons to each, and it depends on your business, your journey, your vision, and your mission. So don't get caught up by hearing things or reading things where people are saying you have to do one or you have to do the other. There is no right or wrong, and it's completely business and personal dependent. We're going to start with holding. So holding the asset basically means you're going to create ongoing rental income, which obviously is a great thing in terms of financial stability. You also often benefit from capital appreciation, especially if you bought right in the right area. As the areas go up in terms of value, as your property goes up in value, so does the equity stake you've got in that. So although you might not be realizing those profits in your bank account, you are realizing those gains in the property. So the rental income and the capital appreciation is a really, really strong point, and something that really drives a lot of investors to hold. The other thing is you are often allowed to release equity through refinance that doesn't trigger a tax event. So there are clever ways that you can do this where you might be able to release equity out of the property and not have a big tax bill. Obviously, you would need to consult with your accountant on this, and it would depend on the structure that you bought it in, etc. However, that is something to bear in mind. It also builds a long-term portfolio. That portfolio strength is actually really important when it comes to lending. Lenders will look at your A&L, they'll look at what you've got on your books, what you've got available to you, and a big portfolio, especially one that's not over leveraged, will hold a lot of weight. So you do have the long-term portfolio strength as well if you were to hold stuff. However, holding isn't passive. You've then got to consider the negatives, or maybe not negatives, but the additional work that you'll have to do if you hold something. So that's property maintenance. There's obviously a cost to that. There's obviously logistics around managing that, having the right access to tradesmen, to maintenance men who are able to come and deal with those issues. You've got project management. So are you using a estate agent to manage the property? Are they doing the lettings? Or are you doing it? If you're doing it, you need to make sure that the compliance is up to standard. That's something that you need to be heavily involved with. If you're not just outsourcing that to a lettings agency who's familiar with all of the tenancy laws, they've got the ASTs on file, they know how to deal with rights to rent and all of those things. So if not, those compliance issues can be quite a big task. So again, not putting anybody off, but these are things to consider alongside the positives that you will need to manage if you keep. It also exposes you to things like voids, arrears, operational risks. If you all of a sudden have a 10-unit block and you lose 4, does that cover your mortgage? Does that break you even? Where does that sit? And then obviously the biggest one is it ties up any remaining capital. Often there will be capital and profit that is held in there that you can't release until obviously you sell. So again, you've got to look at the pros and cons, but there is no right or wrong. Selling, some of the key points for selling. Obviously, the biggest one is the immediate capital and and profit release. So any money you had in that deal to start off with, plus any profit, is going to come back out to you on the successful sale. So you've got instant profit crystallization. Straight away, you get your profits back, you can pay the bank, you pay the investor, and you've got your lump sum to then go again. It removes all of the long-term responsibility. All of a sudden, you don't need to worry about the compliance, the management, you've got no voids, and it dissolves that side of things. It's also ideal if you've got investors on board that need repayment. Often once you've repaid them, it's been a successful development, they'll be ready to go again. So there are pros and cons to both. One of the other things is the sale is quite dependent on market condition. If you're holding long term, you're going to see the market come up, a dip, and you're going to have that little bit of a fluctuation. But rents are always tend to just increase. So you're quite safe in that market fluctuation. However, if you're going to sell and you're selling at a dip, then you might actually potentially lose some of the profits that you'd originally forecasted. You might need to take a bit of a dip on what your proposed profits were at the initial outset of the project. It also triggers tax implications, something to be very aware of. Don't just think, yeah, I'm going to make 100 grand out of this transaction, because you will need to pay tax on those, including capital gains. So that's something you always need to discuss with your accountant and forecast in when you're doing the development as well. Make sure you're obviously compliant in all of those aspects. You've also then not got any access to further rental income or appreciation. And when you go to lend again, you've got nothing to essentially lend against or to sit in the background, which, as I said earlier, funders like to see that in the background. So no right or wrong. However, I am going to give you a bonus point and something that we are really focused on at the moment in our property journey, and that is securing leases. So one of the models is we look at social supported housing, where we can get a lease with a registered housing provider, who they then have a service level agreement with a care provider, and they are able to get government-backed rents provided your accommodation is suitable and suitably built and supported by the local council for specialist supported housing. So that might be people with learning disabilities, physical disabilities, mental health problems, and what we're able to do on that is secure a rent from the council at an agreed rent, and then our registered provider will agree a lease term for us anywhere from 10 to 20 years. Usually it's an FRI lease, so it's self-insuring, self-repairing, which mitigates our risk of voids, mitigates our risk of management, mitigates our risk of repairs, because they are liable and they need to deal with all of that day-to-day fix. So we are just guaranteed the income every month for the next 10 or 15 years. That also causes the building to be worth more than just bricks and mortar. So if you are able to secure leases on things, that will also be a really big upsell, and it might lead you to go from where you were thinking about selling to actually potentially holding. So keep all of those things in mind. So if you think about the hold, we're thinking of long-term wealth, we're thinking stable income, and we're thinking potential growth. And if you're looking to sell, then you're looking for speed, you're looking for liquidity, you're looking for market timed gains. So you might be on a real rise, you might want to get rid while you're in that rise of the market, and then investor exits as well. If that's the strategy you've gone down with your investor, if they need their money back by a certain date, sale might be your best way. So the best choice depends on your goals, your risk tolerance, and your operational capacity. So consider all of these things and don't just fall for what people's narrative is based on their own journey and their own business. I hope this has been helpful.